Okay, bro.
I've always opined that the best starting place is where things converge. That's what I've always opined. Where things converge is the best starting point, is the best starting place. As we undertake this journey, whereby we want to build the financial statements, or we want to prepare the financial statements, you'll always be all right when you start from the right place. Because once you start from the right place, you will not be lost. In other words, you'll be able to navigate as you move. And as you know, accounting is overwhelming. The information that comes at you, the data that comes at you, especially the data, sometimes is overwhelming. So, you must have a well-grounded starting place. And this starting place, we identify it as the elements of the financial statements. That is the very best place to start from that point, and then you build. Because the elements of the financial statements are the foundation, or they set the foundation of accounting. So you'll be starting from a solid ground as you continue building. So it doesn't matter how old you are in accounting. Even if you are 1 day old, the starting point remains the same. Because the moment you have mastered the elements of the financial statements, which we said are the ingredients that makes you build the financial statement. These are the ingredients that you mix. And you have to take a thought at how you are mixing. You have to brainstorm for the strategy to work. These elements have to be mixed using the right proportions. So all we are saying is that you have to brainstorm, and that brainstorming equals the strategy. And the strategy will be good or not so good depending on how you mix these elements, depending on the proportions at which these elements are put together. That's what's going to make your business to succeed or not to succeed. So, like I've said, irrespective of how old you are in the process of learning accounting, I still reiterate that the best starting point is the elements of financial statements. Because the moment you master that, you are ready to go. You are free to go. You won't meet obstacles. You won't get mixed up. You won't be lost. You'll be able to navigate. Because we also say that this could be taken as the compass in accounting that shows you the direction, so that you don't end up being overwhelmed and you don't end up developing the so-called accounting phobia. So, the elements of the financial statement is the first starting point. After which, once you have mastered, and before you master, don't even bother to move further. Before you master the elements, don't move further. That's my caution. Because where are you going? You are going to be lost. Master the base, then you build from the base. I hope that point is well recorded. You start with the base, and then after that, you can move forward. You can now move freely. You can navigate, because these elements don't change, irrespective of the size of the entity, irrespective of the amount of data. It doesn't change. It is uniform, it's consistent, it's uniform. And remember, I said that these elements of financial statements are anchored in the conceptual framework. They are anchored somewhere in the conceptual framework for consistency. You could imagine that what would happen if it were not anchored. we'll be having all sorts and manner of financial statements that will be coming out of the system. But not because they are anchored, we are assured of one thing: uniformity in the reporting system, or uniformity as far as the financial statements are concerned, such that you can be able to compare one entity against another, because the same language has been used, the same determination was used as respects to determining any of these elements of the financial statements. Now that you know the elements, we have to move to the next stage. And the next step takes us to the trial balance. The trial balance. You see, the trial, the word trial means something, and the word balance means another thing. Now, where does the trial balance come from? Where does the trial balance come from? This is a list of balances that is picked from the books of accounts, meaning that all the accounts with balances which are in the books of accounts will end up being brought into the trial balance. Again, one thing you need to note from the outset is this: you cannot even dream of preparing or building the financial statements without a trial balance. That is effort in futile. You can't even imagine it. You cannot think of preparing or building the financial statements without going through a trial balance. That's how important it is. Actually, it is a master file. This is the master file. From here, we can now be able to get all the statements that we may want to prepare. From here, this is a master file, and the balances comes from the books. Which are these books? The first book is a GL. That's the general ledger. Any accounts that are in the general ledger which have got balances at the end of the reporting period, which is ideally the end of the financial year, that balance will be picked and will be pasted in the trial balance. Okay? That balance will be picked. All the accounts with balances, those without balances, with zero balances, they will be left there. They will not make it to the trial balance. Okay? That's another point that you need to note. Now, we also have got the purchases ledger and the sales ledger. The purchases ledger is a book of creditors. That's a book where the creditors are recorded. That is, if you're buying on credit, those accounts are recorded here. Those creditors, those names of those creditors, they will be recorded in the purchases ledger. In the sales ledger, it could be that you also sell. You've got customers, and then sometimes you sell on credit, because that's how business is run. I mean, that's the ordinary way of running business. Sometimes you may not be able to avoid giving credit. So your debtors, your receivables will be recorded in the sales ledger. Okay? Your creditors or your payables will be recorded in the purchases ledger. So what would happen when you're preparing the trial balance? We go and scrutinize the books, and any account which has got a balance from these books, these distinct books, because in accounting we classify. We don't want to be lost. We classify, we give meaning. We classify, we give structure. We don't just go haphazard. We wouldn't go haphazard because we'll be lost. And if you get lost, then the business cannot survive, cannot thrive if you are lost. You know, I can tell you something for sure. A business that does not keep their records is as good as dead, irrespective of how profitable that business is. A business without robust records, without robust books, that business is as good as dead. So, these sources will provide us with the balances which will be pasted in the trial balance. Okay? Then the third book, the fourth book is a journal. That's a journal. The journal will take care of those items that have not been recorded in the three books. Anything outside of these three books will be recorded using the journal. Okay? That's what happens. In summary, now, back to the trial balance. We are trying to balance, hence trial balance. That's why it is called trial balance. You are trying to balance. Yeah? You are picking the balances and trying to balance. And what are you trying to find out when you are trying to balance? You are trying to find out whether the double entry system was observed when recording in the books. The trial balance will make us know whether the double entry was observed. If it wasn't observed, for whatever reason, the trial balance will fail to balance. It's not balanced. Then, because it has not balanced, you go back to the books and scrutinize and investigate and find out what went wrong or what could have gone wrong. So, what we can say or what we can see from this is that the trial balance is a clever fool. I want to repeat that. The trial balance is a clever fool. It is clever because it will guide us. It will show us when the double entry system was not observed. To show us that. But then, if we go further, you'll find that it is a fool because it still covers some errors. It will still balance when there are still errors in the system. Can you imagine that? Did you know that? So don't celebrate when your trial balance has balanced. It can still balance and there are errors hidden in the system. And I'll give you examples. There are so many errors that will happen and the trial balance will still balance. If you omit, for example, if you did not record completely, the trial balance will not tell you that you did not record a certain transaction, a certain item. It will not tell you. It will still balance. When you don't observe the right classes of recording, it will still balance when you record in the wrong classes of accounts. As long as you maintain the double entry, as long as you debited somewhere and credited somewhere, your trial balance will be so happy to balance. If you use wrong figures, as long as you use them twice, on the debit and on the credit, it will still balance. If you enter in the wrong account, in the wrong person's account, in your purchases ledger or your sales ledger, of which, let's say you have got your customers, customer X and customer Y. You enter a transaction aimed for Y, you enter it in X. The trial balance will not tell you that you've made an error. That is why I'm calling it a clever fool. Indeed, it's a clever fool. But it is so important that we cannot imagine that we can prepare the financial statements without, first of all, putting together a trial balance. Hoping that those errors that I've just talked about are not endemic in the system, then the trial balance, it is a tool that helps us to move further and prepare those financial statements we've been talking about. The trial balance. That's how important it is. Now, I want us to put this trial balance under the microscope. What does that mean? What that means is that when you see a trial balance, what comes into mind? What do you see? Do you just see numbers which are in disarray, numbers which are meaningless, information which makes no sense? What do you see? Are you lost when you look at a trial balance? Do you feel like you are dazed when you look at a trial balance? Do you feel like there's no meaning when you look at the trial balance? Oh, what do I see when I look at the trial balance? I see beauty. I see beauty when I look at the trial balance. Because there is a lot of information already here. Even before I go to the financial statements. Just by looking at the trial balance, I can deduce so much. Let's start at the top. Okay? This trial balance was prepared at the financial year ending 31st December 2017. So the first question is this. When did the year start? This year started 1st January of 2017. So because a financial year should have 12 months or 12 periods. That's what is a financial year. So already I can tell, just by looking at the trial balance, I can tell when that year started. What else can I see? By looking a bit deeper. By looking a bit deeper, I can tell that this company is a trading company. It buys and sells. It's a trading company. Yeah? Just by looking at these items, these line items. These are called line items. These are line items, 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 line items. Like that. They are called line items. Just by looking at that, I can tell that this is not a business based on services. This could be a retail business. Could be a shop. This is actually this is a shop. Now once I know it's a shop, then already from common sense, from logic, I can be able to tell how a shop should look like. What is expected to happen in a shop. You see, you start forming logic. You start using the information by forming logic. Already you know a shop. You can see it in your minds. So already you have some expectations. Yeah? There are those expectations naturally that must be met. And once you start finding things are going off, then there is a problem with this strategy of how we're running this shop. This information, just by looking at it, I can be able to tell what strategy has been employed here. And I can also be able to tell whether that strategy has got the chance of surviving. I can be able to read the obituary of a business just by looking at this information. I can just read it. I can tell that that company is going to the corporate graveyard in the next few months. But I'm not a prophet. I'm just looking at the information because I know what is happening. Now, what we need to deduce here is when you look at these line items, you should be able to tell what balances they should carry. You see, we have got a column for debit and a column for credit. But now, how do you tell these line items whether they fall under debit or they fall under credit? That's why I told you that you must master the elements of financial statement, because the information is contained in the elements of financial statements. That's where the information is contained. That's why I said once you master the elements of the financial statement, you are good to go. You are good to go. All you have to do now is to beef up that information. All you need to do is that to do more and beef up and build. You just need to build. After you've mastered, you just have to build. That's all you need to do. So let's go back to the elements of the financial statement. We said there are 5. We said we have got the assets. And when you look at the assets, this is where the strategy is won or lost. Therefore, you need to brainstorm. This is where you brainstorm. Because most of your finances are sunk in the assets. And these assets must be well aligned to meet the strategy. These assets must work together, must be synchronized. We have to reduce the internal friction that makes things not happen. We have to oil the assets. They have to complement each other. They have to dovetail, for the business to operate efficiently. Otherwise, you'll be having a lot of scattered assets, which are meaningless, which is a waste of resources, because these are the resources that we use. And I told you that when you think about assets, think about a certain business. Think about a real business. Then ask yourself, what resources do we need to run this business in the way it should be run? Which resources do we need? Then, once you answer that question, then you know what the assets are. Yeah? And these resources must be made to work together efficiently. Not idle assets. Not assets that are in boxes in some offices. No. We're talking about synchronized. Because the assets, they will follow the strategy. The asset follows the strategy. Asset equals strategy. And if you miss it here, you've missed the strategy. And this is where we sank. This is the biggest component out of the 5, is the biggest component. So, when we talk about the assets, we have to think long and hard. Again, we have to know how to safeguard the assets. Not a situation whereby a logistic company has got 12,000 vehicles, but they cannot account for where some of the vehicles are. Not in that manner. Not in that manner at all. No. What happens is that we have to be able to be accountable, because this is where most of the money has been sunk. And we are saying asset equals strategy. That's what we are saying. Number 2, we say expenses. Again, expenses. These are the day-to-day activities that we undertake. We also have to have some thoughts here. We have to have some thoughts because we don't want illegitimate expenses to creep into the business. And it happens many a times whereby a business, a company, is paying for the wrong expenses, private expenses, for example. It's paying, so it's eating up on the profits indirectly, without seeing. Underground leakage, underground seepage. It's going under, you can't see it. Yeah? And the business continues to lose, and eventually it can't hold together. Continue to lose slowly by slowly, dot by dot. Eventually, after a number of years, the business cannot stand no more. It is hemorrhaging. It's losing blood. Number 3, we said, is revenue. Again, our revenue, where is it coming from? We must make sure that our business is sustained by revenue that comes from the business activities. Those business activities. It's a shop, for example. The money is coming from selling the goods that you are selling. Otherwise, if you find a business that is surviving and the revenue is not coming directly from the business activity that made, or that is the mission of that business, then you should start thinking of other things, because that could be a facade. That's not a real business. A facade is a cover-up, is a vehicle, yeah, is a front of something else. Because for a business to be sustainable, there must be enough revenue that is coming out of the business activities. It cannot be otherwise. Otherwise, it is a facade, and that business is used as a vehicle for other things. Okay. Then, number 4, we can talk about the liabilities. The liabilities. Again, the liabilities. These liabilities means that is obligations to other people. You have taken finances from outsiders, is the one that you are using to drive the business. You could be using it to acquire assets. You could be using it to pay for some expenses. But the moment you see that you are using liabilities to pay for expenses, that the revenue is not enough to pay for the expenses, you are likely or soon you get into problems. You get into financial distress. You cannot be taking liabilities, especially long-term liabilities, to finance your expenses. What is happening to the revenue? Are you not making enough revenue? Don't you have market share? Isn't your business idea viable? You can't be borrowing other people money to pay for the expenses. But at least you can borrow it to expand, because with assets, you're expanding. Then, the last one is the capital. This is what you have introduced into the business. This is what was introduced into the business. And you find that the capital is the residual value, and how you can get it is that you take your assets minus liabilities, you get your capital. What remains? So you're saying residual. What remains? You see? What remains? You take your assets, remove the liabilities. This is what's accountable to other people. This is what belongs to outsiders. What remains is capital. Now, these elements or these ingredients must be brought together in the right manner. By the right manner, what do I mean? The right proportions. You have to think. Are you using so much finances from outsiders? Again, is a recipe for disaster, eventually. Of course, you have to use liabilities to some extent. Not 99%, not 90%, not 80%. Maybe 60%, 70%. 70% is already on the higher end. But depending on the nature of business, because businesses are not the same. Depending on the nature of business, there are those which are more suitable when you have more liability, but there are those which are risky, because the liability increases the risk of business failure. Remember that. We have to connect. As we look at these items, we are connecting. We know what is happening. Because accounting does not exist in isolation. It doesn't exist in utopia. Accounting exists in business. Remember, it's accounting and business. Those two, they go together. Accounting and business, they go together. What you are drawing the account for is a business. It's what you are drawing accounts for. You see, so the two goes together. And that's why we are already scrutinizing. We're already scrutinizing. As early as now, we are scrutinizing. Now, we say that we need to know these balances will appear on which column. Now, what's guiding us is the elements of financial statements. Because we said assets naturally, by default, are debit balances. All assets, debit balances. We had an exception of cash when you take an overdraft. But naturally, assets will give you a debit balance by default. Expenses will also give you a debit balance by default, naturally. So when the otherwise has happened, or the opposite has happened, then you have to go in and investigate. Go in and investigate. Okay. So the two perform the same way. The two behave the same way. What happens to your assets happens to your expenses. And you find that the difference between the two is very narrow. And that's why this is an avenue for manipulating the financial statements. And how do you do that? Is sometimes when you can convert these expenses into assets, you have manipulated because you end up reporting higher profits. You see? Because expenses are supposed to be used to determine the profit. So if you remove them from the income statement or the statement of financial performance, if at all you remove them from there and put them in the balance sheet, what will happen is that you'll end up having more profit for that particular period. So this is an avenue that is normally used to manipulate the accounts. Okay? So these two behave the same. They go the same way. Now, let's move on. Naturally, By default, your revenue will give you a credit balance. By default, those are your revenues. That's how they are going to behave. By default, credit balance. How about liabilities? The same is true. The same is true for your liabilities. Same is true. Then, how about capital? The same is also true for capital. They will always depict a credit balance. All factors equal, they will depict a credit balance. So, these three, again, is one group. So, as long as you master that, you master these two are debits and these three are credits. You are done. You are done. I guess we are done here. You are done. And this will never change. This is a foundation. It will not change. It will not change. This will not change. Not at all. It will not change. Your assets naturally debit balance. Your expenses naturally debit balance. Your revenue naturally credit balance. Your liabilities naturally credit balance. Your capital naturally credit balance. We can add a sixth one, just an extra. That's a hybrid. Sometimes it can give you asset and sometimes it can give you liability. That is an exception. It's an exception to the general rule. All rules have got exemptions. It's an exception to the general rule. Yeah? Doesn't follow the protocol, same protocol. Sometimes it's an item that sometimes is an asset and sometimes is a liability. That falls under the category of other. But generally speaking, we have got 5 elements of financial statements. You can see how they are behaving. They behave in that manner. Now, let's go back to our trial balance and answer the question in front of us. We want to know these items, where do they get recorded in the two columns, the debit column and the credit column. And this is not guesswork. There's no guesswork here. No, there's no guesswork here. It's either you know it or you don't know it. That's where it ends. Either you know it or you don't know it. This is where it ends. I hope you are together that far. Whether you know it or you don't know it. Now, the opening inventory. This is stock. Stock which remains the previous year. So already I can see that this business did not start this year. Just by looking at that. Nobody is telling me anything. No. Nobody told me anything. I'm the one who is saying it by looking at what is happening. Opening inventory. Okay. So last year, there are some items we didn't sell, which were meant for selling. Which was meant for selling. It was not sold. So this year when we are starting, we started by selling that stock. We already had stock when we started the year. So naturally it means that we started by selling out that stock before we could buy more. So this opening inventory, where does it go? What is it? It's inventory. Is it? It is inventory. Therefore, inventory falls under assets. So it's gonna be recorded right here. It's gonna be recorded in the debit column. Right here. Because inventory is an asset. Remember our elements? You debit. Naturally, they carry a debit balance. Our purchases, what is purchases? Purchases represents the stock we are buying. Because we are buying and selling. Remember, we are a shop. We buy whatever we are buying. Yeah, maybe the clothes that we are buying. So we buy our clothes, then we sell our clothes. So our purchases also falls under which category, which general category? Again, is an asset. We are not using any magic here, no. We are using what is already laid down. So purchases is an asset. So it will carry a debit balance. That's your purchases. Good. We are just using what we laid down. That's what we are using. Sort of like a formula, sort of, if you like. Then, we move on. Our sales or revenue. This can be sales, turnover, or revenue. So, the wording can interchange. Yeah? The wording can interchange. It is sales, it is turnover, it is revenue. All of them are acceptable. Okay? So, this time we call it sales revenue. Let's go back and check. Where is our revenue? What happens to our revenue? Credit. So, you come in here and put your balance. Your balance for revenue should be on the credit side. We're just using what is laid down here. You don't have to think. No. There's nothing to think about. You just have to apply. Master this, then you apply. That's all. And you go. That's all. Then, administration expenses. Falls under which category? Debit. So, you come here. That balance should appear on the debit column. Right here. That's where it should appear. Then, wages. We have got workers. We are paying workers. For sure, we are paying workers. Now, wages is some of the cost that we incur when we are running the business. And we must make sure that we don't pay ghost workers. Here we can pay ghost workers. And I'll tell you how you pay the ghost workers. Before, a little while ago, what was most abused by workers was petrol, was stationery, was photocopying, was telephone. Those were the most abused items in the office. But today, it's so funny. Today, that's not the case. We have entered the digital world. In the digital world, the resource that is now abused is time. Time. Because that time is what is being paid for, those wages. It's as a result of time spent working for the business. But you find that due to the social media, somebody will spend 7 hours out of 8 in the social media. So you are paying ghost workers. You are paying ghost workers. You see, you have to be keen. You can keep on paying ghost workers for the longest time, and your business continues to suffer until it goes on its knees. Okay? So, this is an expense. Again, it's a debit. There you are. It's a debit. Rent. You are using a premises that belongs to somebody else. Yeah? Naturally, you have to pay for it. Rent, again, you have to see how adequate. How adequate is it? Are you overpaying? Have you gone into a prime area for a business that does not require that site? You know, you have to think, you have to bring all this together. You have to brainstorm your strategy. Yeah? Why do you want to go to the CBD and you are just selling vegetables? Why do you want that? Are you going to afford that rent? You see? Those are some of the questions you have to ask yourself. There must be some adequacy of what you are doing. Is it adequate? Is it adding up? That's the question. Is it adding up? That's the question. So, rent, again, falls under expenses. Therefore, it's a debit. Telephone. People are calling. We are calling looking for businesses. Yeah? We are calling, following up our customers, and so forth. Again, where does it fall under? It falls under expenses. Is a debit. You see, I'm not thinking. I've not even started to think. Interest paid. Once I see interest paid, then I know there's a liability somewhere. Once I see interest paid, I know there's a liability somewhere. Again, this is something that needs to be thought very well. Because if you start getting finances that are expensive, then you start paying very huge interest. At times when the business experiences a hard time, then you are likely not to be able to survive. You are increasing the risk of running the business. Again, you have to bargain very well. You have to bargain very well when it comes to the interest. You bargain very well. Don't pay 50% interest. Makes no sense. 40% interest makes no sense. Yeah? At least 10% can make a bit of sense. You see? So, interest is something that you have to really worry about. Because it has to be paid, irrespective of what happened. Whether you made money, you did not make money, your customers paid you, they did not pay you, you have to pay the bank. You have to pay the financial. And the financials are not very kind people. They are well known. That industry does not have one of the best people in there. No, they have got their lawyers waiting. Their lawyers are waiting. You default, the lawyers are waiting to shut you down. Yeah? To shut you down at the earliest opportunity. So they can see that they can recover something. Okay, so interest, again, falls under expenses. You are paying, therefore, is a debit. Travel expenses. Why are we having travel expenses in this business? Is it legitimate or not? Is it necessary or not? Maybe it is necessary. Okay? So it's travel, it falls under expenses, it's a debit. Premises. Now, this business, it means that it's got many outlets. Some you are renting, you see there's some rent there, it must make sense. Yeah? And also it has got premises. It means that they have got their own premises. They have built their own premises somewhere, or they own their own premises somewhere, or they bought, or however they acquired. So this business has got its own, and also it's renting out. Yeah? Therefore, it's operating in many sites. You can tell that. Again, you can ask yourself whether it's prudent to operate in many sites. Maybe we should leverage on IT, on social media, instead of having to rent so many sites, of which we end up paying a lot of expenses as far as lease is concerned, as far as rent is concerned. Is a strategy. Because we have to go with the time. We have to go with the time. The time now is not the same time few years down the line. 10 years ago. Today you can operate from anywhere. Digitization, cyber nation. So what is happening? Cyber nation. So premises is an asset, again is a debit. We are not thinking. Shop fittings, again, is an asset. Those shelves and the like. Yeah, for display, again, is an asset. Is a debit. Now, trade receivable, those are debtors. Those are your customers. They haven't paid you. So it's an asset. It's your money. Your money is asset. So, only that has not been paid. Yeah? Hopefully that we're able to conduct a robust credit worthiness, robust screening of these customers, because they can end up sitting in our books and will never recover. Yeah? How did you determine, how did you select your customers? Did you screen them properly? Did you screen them? If you don't screen them, this is another avenue where money is lost in business. Your customers can lose your money. Is an asset. Bank, of course, is an asset. Cash is an asset. Capital is capital. You go to capital here, we say this credit. Just like revenue. So capital is right here. The balance you get as far as capital is concerned, she goes on the credit. The loan is a liability, goes on the credit. Trade payable, those are creditors. Yeah? Those are creditors. It means that you bought on credit. You bought on credit. You also bought on credit. You are selling on credit and you also buying on credit. Okay? So creditors is a liability, goes on the credit. Now, value-added tax is an interesting one. It's an interesting one. It's a hybrid we talked about. Yeah? Sometimes the authorities are owing you. It becomes an asset. Sometimes you are owing, you have to pay. It becomes a liability. So this is a hybrid. It has no position. It's a hybrid. If you are registered for VAT, that's what happens. Yeah? Sometimes you claim, sometimes you pay. When you are claiming, it's an asset. When you are paying, it's a liability. So this is a hybrid. So why I said others. hybrid. Okay? Now, after doing that, then you try to balance. Both sides must be equal. When both sides are equal, then you know that you have maintained the double entry system when you was recording. But that does not mean that there could be no errors. It doesn't mean like that. Yeah? Again, when you look at this trial balance, this is an initial trial balance. It's an initial trial balance. Or is the opening trial balance. It's the opening trial balance. Opening trial balance. The opening trial balance. Or the initial trial balance. This is the initial trial balance because it means that there are no adjustments that have been done. Yeah? There are no adjustments done here. There's no depreciation, there's no accrual, there is no prepayment, there are no provisions. It means that this is an initial trial balance. Once we bring in the adjustments which always come, which are outside these three books, which come through the journal, then we are going to get the closing trial balance. Now, the closing trial balance is the one we use to do what? It's the one we use to prepare the financial statements. You see, it's the one you use to prepare the financial statements. The closing trial balance. But still, we can use this one. And we can just draft some financial statements by looking at these items and asking ourselves, where does every item fall? Where does it go? Okay? So, with the trial balance, you should be able to see how the numbers go to the income statement or to the balance sheet. Just by looking at the trial balance, you should see how the numbers are flying in your head. They should be flying, germinating out of the trial balance, which is a master file, to the financial statements. That is primarily income statement and the balance sheet. Just by looking at the trial balance, the numbers should start flying. The numbers should start flying. You see? For example, opening the inventory, where does it go? It goes to the income statement. It goes to the income statement. That one goes to the income statement. Straight. Yeah? When you are determining your gross profit, you need the opening inventory. Yeah? When you are determining your cost of sales, you need opening inventory. When you are determining, again, your cost of sales, you need the purchases. Yeah? That's your cost of sales, meaning the cost you incurred. Because you have to put the cost on the side and then you see what did you get. What did you get will be on the revenue side. Okay? So, what did you incur for the revenue that you made? Okay? We are seeing there's opening inventory and there's also purchases. Yeah? Those ones will help you to determine the cost of sales. Then, the revenue also goes to the income statement because it will be used to determine the gross profit. Yeah? In other words, revenue minus cost of sales becomes the gross profit. Yeah? This is the top part. This is the top part of the income statement or the statement of financial performance. Yeah? It's an income statement, if you like, statement of financial performance. Okay? It has been baptized to statement of financial performance. Alright. So that's the top part of it. It's a simple one. This one is a simple example. Then, again, your expenses, they go under the P&L section. Yeah? Still in the income statement. Still goes in the income statement, if you like. Yeah? To now determine the profits. Your expenses, they go into the income statement or the P&L section of it to help you determine the profit. The rent, same. Income statement. Telephone, income statement. Interest, income statement or the P&L section of it. Travel, income statement or the P&L section of it. Premises, where does it go? Premises go straight to the balance sheet. Is an asset, is a long-term asset, is a non-current asset. That's a non-current asset. It's an asset that takes long in the business. It's an asset that you use for a longer period, more than 1 year. More than 1 year falls under the category of non-current assets. Any asset that stays more than a financial year. Yeah? One of it is the premises. Okay? Balance sheet. Shop fittings is an asset. Balance sheet. Trade receivables is an asset. Balance sheet. Balance sheet. Bank is an asset. Balance sheet. In fact, this is the lifeblood of the organization. It's the lifeblood of an organization. You can make profits, but as long as you don't have cash, whether in the form of bank or cash, you have no chance of survival. You won't be able to survive because you won't be able to meet the day-to-day obligations where, as and when they fall due. As and when they fall due, you won't be able to meet them. Those nitty-gritties that you need to take care of when you're running your business. You go dry. A body without blood cannot stand. A business without cash available for any emergency cannot stand, irrespective of how big it is, irrespective of how much profit it's making. So cash, item for balance sheet. Capital, item for balance sheet. Loan from the bank, item for balance sheet. Trade payables, item for balance sheet. Value added, it will depend. If at all you are supposed to claim is an asset, if at all you are supposed to pay is a liability. Okay? So of course to go to the balance sheet, either under the asset or the liability section. That's why we say it is a hybrid. Now you can see how we have brought in everything together. But remember that this is a simple trial balance, it's an initial trial balance before we have brought in the adjustments that makes accounting being called accounting, that brings that phobia that people have. But I'll tell you this, if you start where things converge, then you have big chances of even moving to more complications, to more complexity. If you are able to start at the point where things converge, and that is why, in my opinion, I say you have to start with the elements of the financial statements. Because the moment you lay that foundation, you start building your confidence. And then you will now be able to be ready. Your mind will be ready for any complexity. But if you are lost here, you have no chance of moving further. Because as you move further, the complexity will set in. Again, how do you move without a foundation? Where are you going to without a foundation? Stay here, master. And once you master, you will never have problems in accounting. I promise you, once you master these, basic as they are, you will never have a problem in accounting in your life as you progress. Problems always emanate from here, where we become mixed up, we become lost. You cannot connect the dots because the dots are not hooked anywhere. They're not anchored anywhere. Everything becomes like butterflies. Butterflies will be flying all over the place. But with this, your base is solid. Your base is solid and things don't change. As long as you classify it under these categories, the same treatment will be done, irrespective of whether you are dealing with aircraft, you are dealing with ship in the high seas, you are dealing with exploration of the outer space. This does not change. It remains the same. The concept remains the same. It is grounded here. It's grounded on the elements of financial statements. And having said that, I'm PK, your accounting integrity specialist. I hope you got something on the trial balance. And I can be found on Peter K at Winners Professional Trainers. Directly, you can get me by using this email, peterk@winnersprofessionaltrainers.com. I'm a corporate trainer. I'm a consultant at Winners Professional Trainers. I've done a lot of trainings with major institutions, Institute of Internal Auditors, Institute of Chartered Accountants. We have collaborated on several topics, technical topics, and I would want to collaborate with you. And as I've said, one of my flagship topics is when I'm talking to the board or the board audit risk committee, when I'm talking to them on how to be efficient when they are managing from the top. That's my most exciting area, because as I always ask, where do you start? And I always don't get an answer. I also get very excited when I'm dealing with building robust risk registers that are practical. That's another area that I'm very excited about. Having said that, I want us to meet in the next video. Make sure you go through all the videos, because we are going in a sequence. We'll meet in the next one, whereby we are bringing some complexities on our trial balance, because most of the problems that people face are found right here. They are found at the very base, at the very foundation is where problems are found. Having said that, can we meet in the next video? Thank you very much.